seated. We will be starting the event shortly. Thank you. Good evening, ladies and gentlemen. I am Tanaya, and it is an absolute pleasure to welcome you all to Sapient Finserv Conversations 2026. We call it conversations because in an industry often filled with charts, algorithms, and cold data, we believe that the most valuable assets we have is not just the capital we manage, but the clarity we build through dialogue. We believe that investing is about people, patience, and perspective. We live in interesting times. Markets move faster than ever, information is all around us, opinions are everywhere, and yet clarity often feels rare, which is precisely why we curate evenings like these, where we all come together and be equipped with insights and perspective. Every year when we gather for conversations, it feels less like an event and more like a milestone in our journey, a point to reflect and recalibrate. Thank you for being here with us this evening. We hope this evening makes you feel informed and inspired. Without further ado, to begin this evening, let us step back and look at the larger canvas, the economy itself. They say markets fluctuate, but economies evolve. And understanding India's economic backdrop is critical for long term capital allocation. Therefore, to share his perspective on the Indian economy and macro landscape, we have with us a seasoned investment professional, Mr. R. Sivakumar. With over 27 years of experience in asset management and having been with Axis AMC since its inception in 2009, he now leads the firm's investment strategy and research processes. An alumnus of IIT Madras and IIM Ahmedabad, he brings deep perspective on markets and economic cycles. Please join me in welcoming Mr. R. Sivakumar, Chief Investment Officer, Axis Mutual Fund.
Thank you very much. I hope I can be heard. Okay. All right. Thank you. This presentation is very special to me. As of close of business today is when I take over as CIO at Axis AMC. So this is literally the first thing that I'm doing officially as Axis AMC CIO. I've been with Axis since 2009. I've been a fund manager in Indian mutual fund industry since 2001. So it's not that I'm new to this business, it's new to this role. It's also a little special that I'm doing this, my very first official event here in Pune. I've been visiting the city. In fact, I've long association with Sapient. Janak Bhai and I, probably, 25 years plus of having conversations, if nothing else, over a cup of tea. Amit, everybody else in Sapient and broader community here. I've known everybody here for decades now. It holds a very special place in my heart. I'm very happy to be here, therefore. My style in doing presentations, how many people here love PPTs? 2 people, excellent. How many people don't like PPTs? Yes, 99% of the audience just put their hands up. Nobody likes PPTs? I'm going to do a PPT, but please don't look at the slides if you don't have to. Please don't look at the slides if you don't have to. The events of the last 7 days since the US-Iran war broke out has changed a lot of the conversation that I'm going to kind of so there'll be a little rough edges around this deck. Please bear with me because we've had to make some changes on the fly. It's not important. I'm not really going to go through the deck one by one. It's also quite boring to do that. Everybody has sat through, I'm sure, hour-long presentations which really don't get to the point. I want to do just a couple of quick things. 1, what's happening to Indian macro? What's happening to the Indian economy? 2, why have the Indian markets behaved the way they have over the last couple of years? The way forward. And lastly, what's happening with the geopolitical situation? How should we read it? How should we react? Just 3 very simple points. I'm hoping I can finish this in the next 20 odd minutes. Do not make it too long, okay? The first and the most important question is, why has the market gone nowhere over the last 18 months. What in the Indian economy is really underperforming? We've had the rest of the world really doing well. People blame this on AI revolution and various other things. Of course, that matters a lot when it comes to FII flows. It does matter. But that's not the only reason. Fundamentally, the reason people buy equities is because they expect to see growth. Current year, India is growing at 8% nominal. We thump our chest and say 7.5% real GDP growth. Great, yes, fantastic. But when we go and buy and sell our products and services in the marketplace, we are not dealing with real numbers. We are talking about nominal numbers. Equity markets, profits growth, earnings growth, sales growth, everything is nominal. There is no such thing as real in the real world. All nominal is real and all real is virtual. And nominal GDP growth in India is the lowest it's been forever at 8.5% nominal growth. As a child, the chart is there, but you can forget. Actually, if it's not there, it doesn't matter so much. Why is that? Do I get a clicker? Thank you. All right, excellent. Yay, we are in PPT mode. Please don't bother to look at it unless you want to. Nominal GDP growth in India is just a little over 8%. Chart on the, sorry, what is this? Did I go too far? Oh yes, there. 8.5%. The lowest bar there in the middle, fiscal 2026. I can pull this chart back to infinity and it will be the lowest number. When people buy equities, they want to see double-digit growth. If the macroeconomy is growing at 8%, sales, that means corporate sales are growing at 8%. If sales are growing at 8%, earnings are not going to be growing at 15%, 12%, 20%, whatever you want it to. It's in single digits. Nobody wants to buy single digits. This is the number one reason why the Indian markets have been struggling. The fact that economic growth has slowed down. Why has the economic growth slowed down? And what's the way forward? The way forward seems to be a lot better. Our forecast is for growth to come back quite strongly next year and thereafter. But why has it slowed down and why do we expect things to get better? There have been 2 or 3 big reasons why the Indian economy has slowed and why it has slowed when other economies have not slowed during the same period of time. First, the Indian government has cut deficits. This is a choice. The Indian government made a choice to cut deficits. During the COVID years, the government of India ran fiscal deficit of over 9% of GDP. The combined fiscal deficit of the center and states went well above 13% of GDP, which is the highest in the RBI's data series. I mean, they published data from the 1981 onwards to date. We had the highest fiscal deficit ever in the data series in the post-COVID period. From there, from 9% center's fiscal deficit is down to 4.5%. When the government cuts fiscal deficit, that puts a downward pressure on the economy because the government spending is a large part of the economy. If the government spends more and expands its deficit, economy goes up. Nominal, not real. Government spending often doesn't lead to real economy, but it affects nominal economy. Downward pressure from the government downward fiscal deficit pressure from the government puts downward pressure on nominal GDP growth. The second has been the RBI. Between 2022 to 23-24, the RBI was raising interest rates. That puts downward pressure on the economy. It puts downward pressure on the economy with a lag. When the RBI starts increasing interest rates, the economy doesn't slow down next quarter. It takes 1 to 2 years for that effect to be felt in the real economy. That means the rate hikes we started in 2022 took effect between 23, 24, 25. I do have a chart. Might be helpful. The chart on the left. Huge amount of rate increases, and over the last year, rates have started coming down. Again, it's going to take 1 to 2 years for that to turn around in economic performance. When the RBI started cutting rates in 25, it does not mean that 25 you will see a pickup in economic activity. The economic activity will pick up 26, 27 and onwards. It takes 1 to 2 years of lag before that translates into growth. So go back to the previous slide. Both the factors which have been dragging Indian economy down, the government fiscal deficit coming down and the RBI's policies have both turned around. The RBI is now cutting rates, has cut rates and is infusing massive amounts of liquidity into the system. That liquidity feeds into the economy, again with a lag, but it is definitely positively impacting the economy now. The government has stopped cutting the deficit. They are not increasing the deficit, but they have stopped cutting the deficit. They are maintaining a flat deficit number, which means the downward pressure again has come down. The economy can now normalize. Early signs of this have already become visible in the macroeconomic data. It's not visible in GDP. GDP will still be at, nominal GDP will still be at 8, real GDP aside. Nominal GDP is still weak. But bank credit growth has started moving into like 14% growth compared to 9% growth last year. People are borrowing more from banks at a much faster pace than they did a year ago. People don't borrow money for fun. People borrow money because they need in their businesses. The pickup in the pace of credit from 9% to 14% is the best signal that the economy is healing. The second signal comes from the interest rate markets. Some of you who track interest rates in India, bond yields have started going up over the last several months. Since June last year, now almost a year, we have seen a rise in long-term yields in India. Despite the RBI rate cuts, despite the extraordinary amount of liquidity the RBI has infused, RBI is buying government bonds hand over fist, and yet the interest rates are going up, not down. Why? Because as much as the RBI is pushing cash into the system, there is that much more demand in the economy. So the economy is turning around. That's one good sign. We have got through a very difficult last 12-18 months, but the prognosis is a lot better. This explains, I think, a decent chunk of the stress that we have seen in equity markets over the last couple of years. The second is who is buying and who is selling, specifically who is selling. Foreigners have been selling. Every year for the last couple of years, yikes. I'm not going to do this, sorry. I'm going to leave it in the slide. I'll come back to some other points over there. The second point is the foreigners have been selling. The external sector has been terrible for us over the last 2 years. Foreigners have sold, and of course, domestic investors, all of us, we've been buying huge amounts of money. You know the record numbers that every month CNBC Flash is saying that, 30,000 crores have come from SIPs and so on and so forth. So there's this huge amount of domestic flow, but the foreigners have been selling. Foreigners have been selling, leading to a significant underperformance of the currency. The second reason, this chart is a real effective exchange rate of India, but the falling exchange rate is demonstrated here. The second reason for the rupee to fall is the Trump tariffs of last year. We are always very proud as a nation to say that we are not very export sensitive. Current account deficit is small. Trade as a percentage of GDP is small. Why should we be so bothered about tariffs, etc.? All absolutely 100% valid points. We are not overexposed to the external sector. Overall, if you look at the GDP, percentage of exports is low, specifically percentage of manufactured exports is relatively low. Because the tariffs don't apply to software and other service exports. It applies only to goods. But here is a problem. While it's absolutely right that exports as a percentage of GDP is low, manufacturing as a percentage of GDP is also low. In fact, manufacturing as a percentage of GDP has been declining over the years. Why is this important? Because exports as a percentage of manufacturing is not low. For the overall economy, no problem. Exports as a percentage of GDP, current account deficit as a percentage of GDP, no problem. But I'm sure many of you here are in some form affected by the export sector, exports impact, right? most manufacturing businesses have some linkages to global, if not directly, but maybe through your value chain, upstream, downstream, etc. I see quite a few nodding heads around here, right? So even if you're not directly impacted, but maybe your supplier is impacted or your downstream purchaser is impacted. Exports as a percentage of the manufacturing sector in India is reasonably high. So while the external effect on the macro is not big, for manufacturing it's big. This is important for equity markets. When you look at stock markets and the composition of large cap versus mid cap and small cap, large caps in India are dominated by what? Banks, IT, consumer companies and so on. But you won't find too much of export sensitivity there. It's domestic economy, exports of services and domestic services. They dominate the large cap indices. If you go to mid caps and small caps, you see a domination or you see a much higher percentage of manufacturing companies. It explains why in 25 you saw a significant outperformance of large caps relative to mid and small caps as the tariffs bit. If you look at the last 2 years, the data there in terms of large cap, Nifty 50, mid cap and small cap, it's unreadable. Please don't bother looking at the numbers unless you really want to. Versus the FII versus domestic flows. In 2024, when the first wave of FII selling happened, we didn't have the tariff problem. This was largely Indian buyers replacing foreign buyers. And Indian buyers, we are a lot more value conscious. We are not just buying the large cap names. We are happy to buy mid cap, small caps, etc. So mid cap, small caps outperformed fantastically in 24. But 25, similar flows were there, foreigners sold and domestic spot, but the impact of the tariffs are very clearly visible by the underperformance of the mid cap and small cap indices relative to large cap. This again, the story is hopefully changing. A few weeks ago, the US Supreme Court ruled that the tariffs, the Trump tariffs, are illegal. The process of reversing that, etc., and etc., is underway, and we should see a lot less pain coming from the external sector. It's not that the tariffs are going to zero or where they were in prior to last year, but there will be more stability, and hopefully you will not be seeing that weekend. If you remember that weekend when the Supreme Court ruling happened, over the whole weekend, over 3 days, we got 4 different tariff rates. So we went from 50% to 0% to 10%, then 15%, all in a matter of 3 days. We got 4 different tariff announcements. Hopefully that's behind it. Even if it stays at 15, it's fine. But as long as the fluctuation is limited. If the nominal economy recovers, and if we don't see this kind of fluctuations in tariffs, external sector, etc., we do believe that in every other aspect, we are setting ourselves up for a lot better outcomes in macro as well as markets. Still, a few pain points remain which we must discuss, and a few good points which we must discuss. First, on the good side, India is not expensive relative to the world anymore. These charts on the left, India's valuation premium to the world at large, and on the right, valuation premium relative to emerging markets. We are now not cheap, but relatively quite cheap compared to other EMs. Because of this whole India sell-off and other markets going up, other markets have become a lot more expensive than us in the last couple of years. For 2 years now, we do have a reasonable size offshore business. For 2 years now, we've been seeing outflows. This January, we saw our first inflow mandate in 2 years. And this is not a small mandate, we got a $60 million account from Europe. This last month, we have signed up $100 million from a sovereign institution in Asia. Their first allocation to India in a long time. And it will come, it's yet to come, but it will come this year. These allocations we could not have dreamed in the last couple of years. But today, when those value-conscious investors are looking at where to deploy money, suddenly India is looking a lot better. Macro numbers getting better, tariff situation getting normalized, and valuations getting a lot better. Suddenly, conversations which were completely shut to us for more than 2 years have opened up. Money is coming in, real money is coming in from institutional investors, but still real money is coming in. Where always institutional investors are typically, the smart money is always quick to react. We'll wait for the ETF flows to come down the road. But institutional, real value seeking investors are finally making their investments back into India. Corporate earnings are beginning to go up. Unreadable charts. I hate these charts, but they are there anyway. Corporate earnings growth tanked, and this financial year will be the bottom. There's a small V shape over there in the bottom, 10% earnings growth this year. In the next couple of years, expected to go up. What's really interesting is the breadth of earnings has gone up. Small caps are outperforming large and mid in terms of earnings growth. This is the last couple of quarters. It's early days, but what it suggests is that things are genuinely turning around on the ground. This is not just some macro number. This is not just some few large cap companies showing extraordinary numbers. Small cap companies are showing well into double digit profit growth. This is actually very, very positive when you look at it from a market structure perspective. It is not just a few companies which are making money. For the last couple of years, whenever equity analysts have looked at earnings, they have downgraded. Earnings, this chart shows earnings revisions by analysts. For the last couple of years, most of the time, you see all the down bars, especially in the recent past, 24, 25, have all been downward revisions. Now, for the first time, you are starting to see zero to small upticks in revisions. That means incoming data is causing people to revise up their projections on corporate profitability. The combination of all of this, macro numbers getting better, corporate earnings starting to get better, valuations being reasonable, I think is the reason we should be a lot more positive about the Indian markets. Now, having said all of this, let's also look at where the risks lie. We've been a market of IPOs. We had an extraordinary number of IPOs. I'm sure everybody here has invested in many of the IPOs over the last couple of years. A word of caution, IPOs are not making money now. This is a relative performance chart of the Nifty 500 versus the IPO index. NSE has an IPO index, and the IPO index is massively underperforming the broader market. Please don't chase IPOs just because you think there's a pop there to be made. Yes, listing gains are still there, but in many cases, not everywhere. But please be cautious. Don't chase every fad that comes in the market. This is something to just be watchful. We obviously do get to see a lot of IPOs. As do you all. But increasingly, we've become a lot more cautious about where we buy, simply because valuations in IPO in primary markets have gotten very, very stretched. Some rationalism is coming into this right now. By the way, the booming IPO market is also another cause for pain on the external sector. Our net FDI number has crashed. Why? Because all the private equity which came in a few years ago are all exiting here. Booming IPO market means a lot of people who, so essentially private equity has become kind of negative. It's interesting that this is one place where actually you're seeing a lot of stress, also reflected in the rupee. The last point I wanted to make is on the recent developments and the war between, or the bombing campaign that the US and Israel are doing in Iran, and how we should react to it. The short answer is don't. Over the decades, we've had many instances. Sorry, there are some formatting errors. This chart was literally made today. We're just updating a lot of these things. There is some formatting errors and data errors, but don't ignore. But you look at this chart of Sensex over the last 30 years. During this time, we had first Gulf War, Iraq war, then now third Gulf War. We have had global financial crisis. We've had Kargil war. We've had India nuclear testing. Before that, we've had 26/11 here. 2001, we've had the World Trade Center, the 9/11 attacks. And yet, when you look at the long-term chart, almost none of that becomes visible. Today, a lot of this volatility seems to hit us because it's happening here and now. But in a 10-year, 20-year time frame, none of that even shows up, or at least it's not apparent. The only thing that seems to be consistent is that whenever these events happen, shortly thereafter the market bottoms and then it takes off. Even though where the market bottoms, when it market bottoms, I have zero visibility. But time and again we have seen events, maybe 5%, 10%, 15% correction, and markets taken off from there. I don't know whether the magnitude will be similar, I don't know whether the timelines will be similar. But please don't use geopolitics as a reason to change your portfolios, change your asset allocation or change, because we do not know. The short answer is, if you ask me or if you ask anybody, if you ask the President of the United States, he cannot tell you when this war will end. But it will. More than 20% of the world's oil is just sitting today, unable to cross the Persian Gulf. 30% of LNG is unable to cross the Persian Gulf. This is not sustainable. So, war will end. Some terms will be agreed. How and when and what terms those terms are, we do not know, but it will end. If we wait for that resolution, prices will not be where they are today or where they will be at the bottom. We cannot predict that. The only solution, only answer is you either systematically invest your way in or just sit tight. Taking action when things are most uncertain doesn't pay off. So that's the only thing I want to say here. I mean, geopolitics is a discussion we can have forever and ever, but I don't want to sort of belabor the point. I just want to leave, like I said, if I can leave just 3 or 4 messages behind in this conversation. One, starting from the back, geopolitics, understand that it can create a lot of volatility in the near term, but it is not a trend creator. It can interrupt things, it can create significant drawdowns, but when you look back 10 years from now, it may not even appear as a blip. 2, the external sector. Over the last couple of years, we've seen multiple things hammer us. Foreigners have sold heavily. Private equity has sold. Trade has been a problem. Rupee has weakened. Everything has hit us. But a lot of those problems are now behind us. Foreigners, I don't believe, will be incrementally selling. They will sell today because geopolitics affects them just as much as it affects us on the ground here. They might sell today, and they have sold $1 billion this year. They might sell today and they might sell for some more time. But I think we should be expecting an end to that pressure soon. Valuations have gotten a lot more reasonable. And despite this AI-led outperformance of Korea's and China's and the US, valuations there have also got stretched. So we will see relative value investors come back to India in a big way over the next few years. Domestic investors continue to be strong buyers of Indian equities, and I think that will continue. Going back to macro, which is where I started and I'll end, the pain of the last few years in India has been low nominal GDP growth. And that period of low nominal GDP growth, in our opinion, has come to an end, both because of the RBI's monetary policy and the government's fiscal policy. The first evidences of turnaround in the economy is already beginning to become visible. I mentioned the growth in bank credit growth, but it's also visible in PMI, which is basically an indication of survey data on industries. All these things starting to go up, which indicates that economy is turned around quite materially. We are seeing an uptick in earnings, we're seeing an uptick in earnings projections, and we are seeing an uptick in the overall macro economy. If this geopolitical event gives us a great buying opportunity, let's grab it with both hands. I don't know when that would be, and I don't even think we need to bother. Stay invested. I think it's a good opportunity going forward. And that's it. I just thought, keep it crisp. I hope I've made sense. And yeah, that's just it. Thank you very much. Sorry? Yeah.
Thank you very much, sir. In my school days, if we don't study, we used to get a book called as Equis Apexit, that in short while you can study and pass the exam. Your presentation was extremely crisp. In 15 sliders, we had macro, micro, fiscal and valuations. Thank you very much. I would like to call upon stage Rahul Khandekar, sir, and Amor Pagare, sir, to felicitate R. Sivakumar, sir. Thank you. Thank you, sir. Tanay, you can take the next part, please.
Thank you. As investors, we often think about diversification. Diversification across sectors, across asset classes, but increasingly, diversification also means going beyond borders. After all, we travel internationally, our businesses interact globally. Perhaps our portfolio should do the same. To help us explore the opportunities and considerations in global investing, we have with us an industry veteran, Mr. Avinash Satwalekar. He is the president of Franklin Templeton Asset Management India and oversees the firm's retail and institutional business. Over nearly 3 decades with Franklin Templeton, he has worked across several markets, including the US, Malaysia, and Vietnam, taking on leadership roles such as country head, CEO, and CIO. His career has spanned portfolio management, research, and business leadership, bringing together both investment expertise and a truly global perspective. He holds an MBA from the Wharton School, University of Pennsylvania, and is a CFA charter holder. He will be joined on stage by our very own Mr. Janak Shah, Director, Sapient Finserv. Ladies and gentlemen, please put your hands together for Mr. Avinash Tatawekar and Mr. Janak Shah.
Good evening. Good evening, everybody. Like Tanaya said, Avi has been with Templeton for 30 years. And as a matter of fact, Templeton completed 30 years in India as recently as the 26th of February. So, congratulations on that.
Thank you.
They have seen probably everything that has happened in the last 30 years. And it is one of those firms which thinks global but acts globally, acts locally, sorry. On this backdrop, Avi, I'd like to understand your perspectives on what globally FT is doing or what opportunities are they looking at in evolving economies and advanced economies, and what is the firm focusing on when they're looking at these economies.
Perfect. Thank you, Janak, and good evening, everybody. So, what does Franklin Templeton do? I mean, I think for most of you, hopefully that's not a mystery, but I'll give you a quick 5 minutes on who the firm is. It's a 77-year-old asset management company that was founded in the US, is still headquartered there. As Janak Bhai said, that we've been in India for about 30 years. Now, we've been one of the original emerging market investors since the early 90s, I would say. It was actually in the mid 80s when I think one of our senior leaders at the time, Mark Mobius, had ventured out into the emerging world and started investing. In fact, India was one of our first investment destinations as well as the rest of Asia. So today, when we're looking at the globe, we are total about $1.6 trillion in assets. We are present in 36 different countries. And we've got over, I think, about 1,200 investment professionals globally. The idea of having this global footprint is that we get, as Janak Bhai said, local understanding while having a global framework. So when we're looking at different economies globally, the metrics are typically the same that we analyze based on. So where are we looking at opportunities now? We're seeing opportunities actually in the US. We're seeing opportunities in Asia. We're expecting China. We're looking at Korea. I know Korea's had a rough couple of days, but we are longer term investors. And how do we look at investing? It's based on a multi-year view. At a minimum, it's 5 years from an investment perspective. When we're looking at it from the business perspective, it's much longer. I mean, that's what has allowed us to stay in India for 30 years, for example, right? When, as you've seen, a lot of foreign firms have come and gone out of India. But I think where are we looking at investment opportunities now? I think investment opportunities are available pretty much in every market. We look at, more importantly, what are the themes that you're looking at. So the themes that we're looking at are predominantly areas that are going to be impacted from a secular basis. So AI has been talked about a lot. That is one area that is going to be impacting every industry globally. So how do you participate in that segment? How do you look at that segment? Energy transition, that is another important area that we are looking at, and this happens across the globe because you have suppliers in different parts of the world and you have users or consumers in different parts of the world. So India is a big opportunity for us that we've identified over the years. China continues to be an important one for us. Recently, Europe has started to see more of an interest, not because of anything other than the spend requirements that you're going to start seeing in Europe on not only defense spending, but also on them trying to readjust and restructure their economies. So there are some pockets, but a lot of it is driven by trends that we are looking for.
Great. So we just heard Shiva saying that there has been a lot of selling from the FIIs over the last 1 or 2 years. And from your perspective, you said that you are, as a firm, looking at India. Do you also get a feeling similar to Shiva about money coming back into India through the FPI route or through the FDI route, or where do you think we're going?
So let's put it this way, right? I mean, I think there's a lot of ink that's spent in the press on what foreign investors are doing and why they're doing it, and are they coming in, are they going out. Our markets are far more resilient now, I feel, compared to what they used to be with the impact of the domestic investor expanding. Now, are we seeing more flows coming in or are we seeing more flows going out? Right now, so we've always been longer term investors. So our flows are not typically indicative of what other foreign investors are doing. We've always been invested in India, and even our emerging market funds have a fairly healthy allocation to India. Now, why has the foreign investor decided that in the last couple of years, right? I think our previous speaker talked about kind of macro is going to start recovering. That macro recovery has to translate into corporate expansion. Only when it gets into corporate expansion do you start seeing the stock market react. And so if you see in the previous 2 years, our earnings growth was low single digits. Now, low single digits, India has always been expensive. So I don't think there has ever been a time when India was not considered an expensive market. And I don't think India should be ever a cheap market, because India offers growth that no other economy offers. So you should be willing to pay that premium, and most foreign investors understand that concept. But that premium that you're paying for has to be translated with visible growth. And when that growth doesn't show up, then you're paying for a premium makes it much harder to justify. And so what ended up happening, I mean, the big onslaught of, or let's just take a walk back on what drove the big outflows, that started at the end of 2024 actually, right? Where we started to see a disconnect between our earnings growth projections and where we were trading at as a market. And at the same time, China had stabilized and was trading at 8 to 10 times earnings compared to 20 plus times for us. So from a global investor's perspective, it almost became a simple trade. And that's exactly what we were. So we tracked what a lot of what the flows were doing. And a lot of the hedge funds that were invested in India pulled money out and shifted it into China. And that lasted till obviously the tariff situation came around. Then it became a little trickier. But our earnings growth should start to recover in 27 and 28. And when I say recover, we are going to start seeing mid double digit growth. So we're expecting anywhere from 15 to 16% growth in earnings compared to what we ever put up, which is 7% earnings growth in the last year. That changes the dynamic dramatically, right? Nobody that has invested in India has ever invested in India thinking it's a cheap and reasonable market to invest in. It is always invested in India expecting to get growth, right? If you had used valuation as your metric, you probably would have missed 40 years of investing in India, because we've never been cheap, right? So I think that is where you're going to start seeing that shift in terms of interest of foreign investors coming back. Now, when is that likely to happen? From a timing perspective, obviously, I'd love to be able to pinpoint that, but we don't have a crystal ball any better than yours is. So what I'll say is that if you're talking about 2027 starting to see those green shoots in terms of earnings recovery, the markets tend to discount that by about 6 months. So by the middle of this year is when you will start seeing analyst predictions, or I would say analyst estimate changes for earnings start to move up, at which point markets react positively.
Okay. So you think there are green shoots, but maybe another quarter before they will start becoming more visible.
I think, I mean, a quarter at the very least is when you will start seeing those green shoots show up. Now, the one caveat, obviously, and I know everybody loves to see fine print, but the one caveat is what has happened in the last week.
1 week.
Right? That, if that extends out, that is going to have an impact, not just on kind of the mindset of the foreign investors looking at it, but even the risk appetite itself, right? So I think barring that, you will, just if I'm looking at pure numbers, we should start seeing that recovery. Now this has the potential to derail it a little bit.
Yeah, so looking at the last 15-18 months where we've actually seen nothing happening, and on that backdrop, and since you are a company based out of the US, is there any view that is coming out of the organization in terms of the Trump administration, tariffs, the way the oil of course now is on a boil because of the current situation, but do you have any view on what is happening over there or the thought process there?
So tariffs, so let's kind of break this down a little bit, right? When you're looking at tariffs, the main target for this, the change on tariffs, or the where Trump has gone after, the main target was China. all the other countries then became, I mean, essentially caught in that net to a certain extent. Now, if I'm looking at how that impacts India, right? India is not an export-driven economy, right? So the impact on a GDP basis is fairly minimal. Now, there are a whole bunch of sectors that are impacted by tariffs, and for those sectors, it is painful, no doubt. What we have seen is that 50 has now gone to 18, that 18 now, given what the Supreme Court of the US has ruled, maybe that is also going to be questioned itself. Any tariffs that we have paid, I know there's an expectation that we might get that money back. I would not hold our breath for that because that will be caught up in legal framework in the US for a while. But is there an expectation that we will see a steadiness around tariffs? That is the expectation now. That volatility around policy change around tariffs will hopefully have died down. Because you've either agreed to a number or that number is no longer valid and you have no authority to do it. Either way, tariff gets taken out of the equation to a certain extent. And that's what the overall underlying assumption is.
So on that backdrop, if one were to look at the global economic outlook, I mean, are we going to see some growth? Like you mentioned that Europe is some place where you're seeing some activity.
So from an, I'd say, growth perspective, so overall growth expectations for the global economy is about 3.5%. Now, that was prior to last weekend's activities, but barring any extended period, I think we should be in that range. Pockets will be more in, I think our expectation is in the US, Europe is where we're expecting to see more, slightly more growth because of the spending activity. And that's, I think, where you expect regional activity. Now, Asia in general has always had a higher growth rates, right? We've seen a recovery in Japan to a certain extent. Now, we've also seen inflation in Japan starting to come up, correct? So, there, from our perspective, we've always been diversified, at least at a global level. But where do we see opportunities? It's more US, Asia, to a certain extent in certain selective countries. And that's kind of like Korea and Taiwan. And those are not just the AI infrastructure, it is also overall technology. So technology disruption has been going on for 20 years. It's not a new concept. It's just changing at an accelerating pace, and the direction is changing with AI.
Considering that nothing has happened to the stock markets in the last 1 or 2 years, and you've suddenly seen a large activity, and everyone here in the house probably has also moved some money to gold and silver, and that has become a conversation point in almost every dinner or every party you attend. Is there any view that you have on gold and silver as an asset class, and then the role of a product like a multi-asset allocation fund?
So I think gold, I think on average, the average Indian net worth has about 17% invested in gold already. So that is a combination of gold that we buy every year during Diwali. It is a combination of the gold that we have invested over a number of years. So 17% of our net worth is already tied up in gold. Now, gold as an asset class has done well for very specific reasons, and that's been more recent, right? So we did an analysis where we looked at over a long period of time, looking at different asset classes, simple Sensex investment versus a gold investment versus a government bond investment. And what we found was that until the last 2 years, gold was performing exactly in line with what government bonds did, which is a 9% compounding return, right, over a 30-year period. Compare that to an equity market, which is done 14, 15%, right? So there is a dramatic, so now obviously the last 2 years of gold have been disproportionately impacting that return, and to a certain extent it's valid, right? There is this whole concept or the whole notion that we're moving countries are trying to move away from the US dollar as a core currency in their balance sheets from the central banks. As they start to shift that, there are no real alternative currencies, and gold is being utilized as that as a potential hedge, right? So is gold likely to continue going up, which is the natural question? The answer is kind of couched in the way, how does central banks think and feel about their allocation in their balance sheets to assets that are non-dollar, which is also a bit ironic because gold is quoted in dollars. So your value even on your balance sheet is based on a dollar. So I think gold is, if you're looking at it from an asset allocation perspective, by all means you should have it, and that's where, to your point, multi-assets make sense. But having disproportionate allocation to any asset class is not recommended. I mean, if you remember 2 years ago, you could replace gold with small caps. And everybody wanted to have small caps and nobody could have enough small caps, right? And then sure enough, we had a meltdown in small caps right after. So no particular asset should be a disproportionately large allocation in any portfolio. And that is something that we've always felt that diversification is critical. And what we found is that we did an analysis of a whole, when you're looking at diversified asset classes, over the last 20 years, equities have come out on top 11 out of 20 years. Gold has come out on top 8 out of 20 years. But you know who's come out consistently second place? Hybrids. So that's balanced advantage fund, multi-asset funds. Those have consistently come out second. So when you're looking at what are we looking at or what do we want as investors? Yes, we want to have the best returns, but why? We want consistency of returns and over long periods of time, because that's how you create wealth. You don't create wealth by having best performing fund every year, because honestly the probability that you will have the best performing fund every year is pretty close to zero. So I do feel that multi-assets do offer that viable way of having exposure to gold rather than just going out and having a large chunk in gold yourself.
And any view on silver?
So silver is slightly different, you know. Silver has industrial usage also, and therefore tends to be a little more volatile. Now, what I'll say is that gold and silver, when we're looking at it, we think of it as one. It's not a, don't differentiate between the two, because the usage of the two different entities, right? And especially when you're looking at multi-asset and an allocation within that, I don't think you want to do gold versus silver. It's you looking at it as a metal or a commodity bucket.
So could I say gold is like a large cap and silver is more a small cap or a micro cap?
If you really must put words in my mouth, then sure.
Okay, thanks. So you manage money outside the country also. Yeah. And I wanted to understand from you where our clients could look at investing in other parts and how or which would be the best way to go about doing that.
Yeah, so I've always, I mean, diversification is very important, and I find that diversification comes through different areas, right? You have asset class diversification, you have market cap diversification. You also need geographic diversification. I don't think, and that I don't think is a new notion. Anybody that has been investing for a while should have at least a 10% allocation outside of India. And the reason for that is fairly straightforward. We all have, to a certain extent, some connection outside of the country. Now, either that is from a child's education standpoint, or even simply from a vacation standpoint. When you put dollar or rupees out of the country, you're essentially giving yourself a minimum 3 to 5% buffer, because that's what the Indian rupee has depreciated against the dollar on average, right? So I feel that you should be looking at opportunities anyway outside of the country to diversify. There is no point having concentration even at a geographic level. Now, where would you want to look at it? There are a couple of different pockets, and I mentioned the countries that we are optimistic about, but you always find opportunities. I found that, and maybe I'm slightly biased because I spent a good chunk of time investing in the US markets, that the US markets bring together the best when it comes to innovation, capital allocation, and your ability to take advantage of global trends, right? So I think allocating to the US markets has always been, in my mind, a really good strategy to get that initial geographic diversification. And that is something that I still think holds steady, in spite of the fact that certain, I would say, long held beliefs are being challenged by the current administration. But from an investment standpoint, from a growth standpoint, from an innovation standpoint, is definitely there. Now, if we look at Asia, right, China does a lot of innovative activity. And if we've seen where they are leaders in a lot of different areas where they are challenging the US leadership. Now, as an investor, our focus has to be on how can we participate in that growth and to what extent we can participate comfortably, right? The reason the Chinese markets were trading at single digit earnings was because a couple of years ago, they overnight changed the rules on certain sectors and completely decimated those sectors. So the capital market participants no longer felt that comfort to invest in China. Now, as you all know, that anything in financial services, once you challenge that trust bond that you have, it takes a while to rebuild that. And that's where I think China is today. They may have a lot of the innovative technologies, but the I wouldn't say reluctance, but the slowness of foreign investors willing to commit capital is partly because of some of those regulatory changes. But China has definite. So you find tangential ways. You look at Taiwan and Korea as those are alternatives. But all of that, in my mind, gets captured with an investment in the US.
So on that note, you all have already set up, or you all are in the process of setting up Gift City.
Yeah.
Would you like to throw some light on how our investors could take advantage on the initiatives that you all are doing at the Gift City?
Right. So I think Gift City is actually India's answer to Singapore, answer to DIFC, where where the idea is to create a international center, a financial center that attracts capital into the country and provides that as a good conduit. Now, coming into the country is fine. For us, the interest also is on both sides, right? It's bringing capital into the country, but it's also taking capital out of the country, right? Which means providing investment opportunities elsewhere for Indian investors. And what we're finding is that the LRS route has been very much understood. Gift City forms a part of that. It's just far more efficient because the ability to bring funds in there is much easier. So we've just launched our fund to bring capital into the country. We'll soon be launching our funds, and they'll be all feeder funds to existing funds that we have elsewhere, where you're going to be able to then invest in those markets or those funds very simply.
Great. So thank you so much for your insights.
Sure.
And if anybody wants to ask any questions in particular, please feel free to.
Sir, when you spoke about investment in gold and silver, uh, there is also another instrument which is called as ETF. So what is better, to invest in gold and silver through ETFs or physical gold and silver?
Gold and silver in ETFs or physical gold? Okay. Let me ask you just broadly, what is your allocation to gold right now as a part of your overall net worth?
Approximately what you mentioned.
So why do you feel the necessity that you need to have more gold?
Because I'm allocating more in monthly in other areas as well.
So you're not changing your allocation.
Right.
So you're just looking as the vehicle. Is it better to have physical gold or is it better to have
Absolutely.
an ETF exposure?
Absolutely.
Right? So I don't know. I'm sure Janang, you've got a different view to it, but my simple, I'll give 2 words on this or 2 sentences on this is when you're looking at physical, right, your liquidity is dramatically lower. Whereas when you have an ETF, you can liquidate that any time. Now, that does not mean that the friction cost is necessarily any different. So there is, when you're looking at an ETF, that's also backed by physical gold itself. It's just not sitting in your locker. It is sitting hopefully in somebody else's a consolidated locker. So there is the function is the ease of getting in and out of it, and what is the purpose of doing it. If your purpose is to keep it as a long-term store of value, then you want to think of it as a physical format. But if it is from a trading perspective, to take advantage of a short-term movement or even a medium-term movement, then I would say you've got better off in an ETF.
Thank you.
Questions? Any more questions?
Anybody, anything? Otherwise, Vallabh, you can.
I have a question.
Please.
You mentioned about China investment, and if you look at Chinese markets,
Yeah.
for last 10 years, they have not moved anywhere. So when you're looking at global investments, and I'm not talking only China, let's say a Brazilian market or any other emerging market, where the markets may not move for a very long period. And when we talk about multi-asset, which is second in the line, how these global investments, X of US, which in last 10 years has done very well. If you go in the decade of 2000, it would have done the worst. How do you look at allocation in those kind of scenarios?
Sorry, so let me just make sure I understand. Your question is that how
In
do we look at
global markets which don't do anything for a very long period, like China,
right?
right? How do you invest in those markets if they don't do anything for 10 years?
Yeah. So
Least likely that investor would stay put.
that's precisely why I'm not necessarily advocating that you invest in China. I'm saying that, and it's not easy to invest in China either, right? If you look at it, like you said, the 10-year track record of China on the equity markets has not exactly been exemplary, right? Whereas any other market, a 10-year track record has been pretty decent, especially when you look at India and the US. To start with, if you're not doing geographic diversification, or that's not a big part of your, there is no sense in my mind to go to multiple different countries. I would much rather have a ability to take advantage of the global themes that are playing through and have exposure to that. And in my mind, the best way to do that is to have an allocation in the US markets because they are the most liquid, the most developed. You have, I mean, the rule of law is very clear. Your ability to get in and out of your multiple options. So I would rather do it that way than explore other countries also because it becomes, you're, you're never going to have a big allocation to any single country for the same reason why we don't have big allocations to any one asset class. So then it's not, to me, it's just not worth the hassle to think through which one of those countries we want to do it. But as a global investor, see, that's the difference, right? You're looking at it from a perspective of saying that I've got local teams in all these different markets. So we're not necessarily investing in a asset class or in a country diversification. You're investing in specific companies in there. That is slightly different.
Got it. Thank you. Thank you, sir. One question.
Hi, good evening.
Good evening.
I had a question. Probably it's maybe from the gentleman who presented earlier. There was a slide in that, but I think any one of you all would be able to answer that. So when we invest, when markets go up, we are always told, oh, it's a great time to invest. You should invest now. When the market falls due to a lot of external factors, we are told, oh, buy the dip. So typically as an investor, I always realize that when there is a dip or when there is an opportunity to really take advantage, you really don't have any funds left with you at that point in time. Okay, because when it goes up, we invest. When it goes down, we are asked to invest. So as an investor, what do you suggest is what percent for an investment when it dips, when the market really falls, what percentage of money should an investor really try and bring in at that time to really have any meaningful impact to generate any alpha on the overall market? Because if a person, example, has 100 rupees invested, if the market dips, whatever, 10%, 20%, you know, if I'm a salaried person or even if I'm a businessman, at that point in time, you really can't really suddenly bring in money. So what percentage should you sort of have in your mind? Okay, if the market has fallen X percentage suddenly, that it should be really bother of putting in X percentage at that time to take advantage of an alpha.
Okay, so let me make sure I understood this, right? So you're asking about when there's market volatility, how do you essentially take advantage of it and how do you put money to work?
That's right. Yes.
Right?
Yeah.
So I think I'm sure everybody's heard of SIPs, right?
That's right.
Right? SIPs in my mind have been designed precisely so that we don't have to figure out. What you're trying to say is, how do I time the market?
Not really time the market. So over the years, I've noticed it's really impossible to time the market. You don't know when the top is, you don't know when the bottom is. You only
Perfect.
know it in hindsight. But when you know, okay, in the last few days, you saw the market correcting maybe 1600 points one day, it corrected another 1000 or 1400 the other day. So at that time, you'll get a call in saying, okay, this is a good time to put in.
Hmm.
So I'm asking, is at that time, okay, I understand it's a good time to put in some money, but what percentage of my corpus really would have any impact on by doing that?
So let's put it this way, right? I mean, I think the problem that we face a lot of times is that our starting point of the discussion is based on trying to make investments targeting returns, right? We need to we've always advocated that we need to take a step back and basically identify what your longer term goals are and then make adjustments along the way. Now, when you're saying what percentage of your portfolio needs to be liquid to be able to take advantage of this,
Yes.
that's a function of, quite honestly, what percentage of a drag you're willing to accept on your portfolio. Remember, any cash you keep aside is dragging on your overall portfolio returns if the markets are going up, right? Now, it's another way of saying, how am I going to time the market? So, my view has always been that you want to be invested in the market all the time, right? SIPs allows you to buy that when it's down, you buy more units. When it's up, you're buying less units. But that doesn't mean that you're not getting cash flows. Like you said, salaried person or a business person, you are still getting cash flows and you're having more opportunity to invest. So it doesn't change the fact that you will have liquidity to make those investments. Now, the way I look at it is, you mentally have to decide a plan. See, when a market gets hot and starts to get toppy, generally you'll have enough pundits that are crying out saying that, you know what, it's getting nervous and this and that, and you'll have enough, Janak Bhai will come and tell you that, you know what, things are getting a little stretched, you might want to think about keeping. So at that point, you have to put a plan in place to say that, okay, if between this point and the end of the year, I envision having X amount of excess cash available. If the market drops 10%, I will put in 20% of the cash that I have on hand. If the market falls another 10%, I will put another 30% of the cash. Whatever that number is, the critical thing is to set that plan before the event happens. Because I can guarantee you that if you try to set that plan while the event is happening, you will do nothing. Because the fear factor will be so high when the markets are dropping. And then the classic dialogue that I hear all the time is, it's gone 5-10%. No, I think it will go further. Then I will come. The other brilliant is, why don't I sell now after being down 20 because I want to save the next 10. So all of those are just, in my mind, you have to have a plan in place before. And if you are, I mean, it sounds like you're an experienced investor, you've gone through plenty of ups and downs, right? The biggest challenge you have is your emotions. And the more you mechanize the investment process and make it mechanical, the better your outcomes are going to be. The challenge we all have as investors is that when we are facing a lot of red, I mean, markets were down another 1,000 points today. I mean, nobody, I can guarantee you, if anybody opens up their portfolios, they're all going to be looking rather miserable, and tonight's not going to be as fun, right? But that is because we are so emotionally tied to that number. And our ability to take away that emotion is critical. Because if you can take emotion out of your investment process, you are going to be far better than, I would say, the majority of global investors anywhere. And that is the biggest challenge. I mean, it sounds very simple, right? I mean, yes, it makes logical sense, no? Buy low, sell high. How many times have you heard that? It's very difficult to put it into effect.
Thank you. Sure.
We'll wrap up, sir. I think we'll have it during the dinner conversation.
Avi is going to be with us for a while, so we can take questions later.
Sir, thank you very much for this insightful talk on global investment. Though it is extremely difficult to look at global investment, it's difficult to invest in India today. So global is even further down. So thank you very much for that. I would like to call upon stage Bhavesh Khetan sir to felicitate Avinash sir. Bhavesh sir.
For our next session, I'd like to invite someone who needs no introduction to most of us in this room. Known for his sharp insights and thought-provoking perspectives, he has this unique ability to make complex market ideas feel truly engaging and accessible. Ladies and gentlemen, please join me in welcoming our very own Mr. Amit Bivalkar, Director, Sapient Finserv.
Good evening. Good evening. I am under weather. You should be fine. After hearing to Avi, you know that exactly you want to invest outside India and not in India. After listening to the first guy, we almost felt that last 10 years there was no return and still my portfolio is staying at 12% CAGR. Somebody asked what happens is buy the dip, and we don't get that much money to invest. And therefore, what we realized last year is that we should have a tie-up with someone who also has a NBFC so that we can pledge your units and create that liquidity. And that's the reason we have tied up with Equirus as a group from Bombay, and I'm fortunate Ajit is here. Ajit Deshmukh is the Vice Chairman for Equirus, and very happy to say that as a group now we'll be managing over 35,000 crores as assets under management under Sapient. So thank you Ajit, and thank you for this opportunity to collaborate. Sapient stands for wisdom, and the logo, the symbol is an owl. So while you have a comfortable sleep, we are awake to look at your portfolios. And Equirus stands for equities are us. So two companies, more research, and same goal, client come first. So thank you for attending. I think we have a full house, about 800 people in this room. So a round of applause for all of you. As usual, I have nothing to do with markets, and I don't intend to get into the talk because we have experts to do that. But what I intend to do is quickly present in about 5-10 minutes whatever investment lessons we have learned, and this time not from Bollywood or from Amitabh Bachchan or from anything else, but this time from fables and stories, and something what we have heard, learned from our grandfather, grandmother, and Aesop Niti and all of that. So let's try to get this wrapped up quickly. Can I have the sound please for this? So whenever we say that investments people are here to tell stories, I would say that we have to learn from stories, and rather than stories, we have to talk about narratives. There is no greater power on this earth than a story, said Libabre. When we go and hear these 10 stories, what I'm going to tell you, it's a couple of minutes on each story. The first one is the over-optimistic turkey. There was a turkey, and there was a farmer who used to feed that turkey every day. It happened for 1 month, 6 months, 1 year, 2 years. And the turkey started feeling that the farmer actually, it's the turkey's right that the farmer will come every day and he will feed the turkey. Obviously, the turkey had been used to getting free food, and this happened for about 900-950 days. One media person went to the turkey and asked, okay, now you have so much experience for the last 950 days. He interviewed the turkey on the 999th day. And he asked, okay, so how's your tomorrow going to be? So she said, as usual, the farmer will come, he will feed me, and then I'm fine. Life goes on. Unfortunately, the next day was a Thanksgiving day, and the turkey got cut. Whatever happens in your life in 999 days may not necessarily happen on the next day. So if you have got a 18% return on your portfolio for the last 5 years, attribute it to the liquidity created by Corona, and don't extrapolate that return for the next 5 years. The next 5 years can be 9% compounding also. That's the over-optimistic turkey, that we generally get used to something which we have not seen, and we say that this is our right. There are a lot of bond platforms which have come into the market which say that they will give you 12%, 13%, 14% return. Yes, out of your 100 rupee invested, they will give you 13 rupees in return. 87 can be a loss. So please be aware of where you are putting your money. Second one, everybody knows the monkey and the cap seller. Cap seller came to a village. He had all his caps in his bag. He sat down. While he was asleep, the monkeys took away the caps. He realized that the monkeys are not giving his caps back, so he puts his own cap on the ground. Every monkey did the same thing. He collected his caps. He went away. Cut to today. This guy actually has a grandson who is also in the same business. He also goes into the same village. He goes, sits under a tree, shady tree, and he falls asleep. There's a monkey, a group comes, takes away all the caps, goes and sits on the branches. The guy wakes up and he realizes, oh, my grandfather also had experienced a similar phenomenon. So he puts his cap on the ground, but this time none of the monkeys do that. So he was a little bit surprised. He said, अरे आजोबांनी तर सांगितलं होतं पण हे तर असं काही होत नाहीये. So he is staring in disbelief that he has made a loss. So one of the monkeys comes down and he whispers in that guy's ears की आम्हाला पण आजोबा होते. So most of the times काहीतरी मागे झालंय. आपण जसं क्रिकेटमध्ये म्हणतो ना की एका जागी बसला असशील तर उठू नको, विकेट जाईल. तसंच काहीतरी इन्व्हेस्टमेंटमध्ये असतं की वी आर यूज टू समथिंग अँड वी आर नॉट विलिंग टू लिसन टू opposite views. म्हणजे last 1 year, when 1.5 years rather, when we have shifted all of your money from mid and small cap to arbitrage funds or multi-asset allocation or balance fund, when they were not doing good till 15 days ago, you all were saying, अरे कशाला आपण switch केले. आणि 15 दिवसात when the markets have cracked more than 5-10%, Vallabh tells me some of the clients have called, अरे जास्त का नाही switch केले multi asset ला. So remember this की प्रत्येकाला आजोबा आहेत and we have to learn from this experience. This is philosophical. Generally when there is a sandstorm, the sandstorm gets originated somewhere else, a tornado for that matter, and it keeps on swirling and it passes on through a city or a village or a town. And generally you try to save yourself from that sandstorm. The sandstorm is actually not created by you. It has originated somewhere else, but it is passing through your village or city or town. It is just that how you can save yourself from that sandstorm. Generally a 60% equity and a 40% debt portfolio saves you from that sandstorm. And most of you whom we have been managing are a 60-70% equity portfolio today. But what Buddha teaches is clearly the sandstorm which is going inside your mind. How will you remove that? Watching gold and silver over the last 1 year, it gives you only anxiety, pressure that I have not invested. Or if I had invested in silver when silver is going down, it gives you more anxiety. And you end up giving more money to the physician who will subscribe you blood pressure tablets. Buddha actually teaches you that can you just stay away, step back and think what is actually happening. If you can have a clear view, then probably it leaves a deep impression and we are not bothered by the events going around us. Next one is monkeys and the goats. And we all hear that we call Roger Federer the goat. And GOAT actually stands for greatest of all times. And investments are just like this. Remember 1 year ago when you had the defense fund which was launched and all the indices which were based on defense, and there are only 11 companies in India where most of the competition went and sold defense funds. Those were the monkeys. Because they swing from one branch to another and those are the darlings of the market for a very short period of time. But goats are your greatest of all time companies, wherein they might have a bad quarter, they might have a bad year. But definitely these are the companies which have the resilience to stay in a sandstorm and probably return better over the next 1 decade. So when you are investing, do not fall for any fad, any thematical where somebody is advertising it or tom-tomming it because it has delivered return in the last 1 year. I think in the month of January this year, we gave you a call to exit all US tech funds. That is something which comes from a lot of research within the company. And we take pride in giving these calls, sticking our neck out, because we feel that your money, we are morally responsible to manage. So when you are investing, invest in goat companies rather than going in for monkey companies. This everybody knows. The guy goes, he loses his axe in the pond, and then the first axe is a golden axe, and the guy says, the greedy guy says, yeah, this is my axe, and then he doesn't get anything. The guy who was true to label, he goes and says, no, this is not my axe. Then comes a silver axe, he says, this is not my axe. Then comes a wooden axe, an iron axe, and he says, this is my axe. And then the angel gives all three. The wooden axe is actually your core portfolio. The gold and silver axes are toppings or your tactical portfolios which you should be looking at. But in a bull market, you are blindsided by returns, and where you start thinking your gold and silver as your core portfolio. So right now also Avi got a question on gold and silver. Let me ask you a simple thing. Even if I tell you today, and don't take me to action on this, but if I say to you that silver will become 5 lakh rupees a kg, will you redeem all your equity and put money in silver? If I say today gold will become $6,000 an ounce, will you redeem all your equity, your fixed deposit, sell off your house and buy gold? So I find a lot of clients who just forward some YouTube content to me and ask, is it true? Question mark. तर आपण गालगोटिया युनिव्हर्सिटी सारखं व्हॉट्सअप युनिव्हर्सिटीमध्ये नाही जायला पाहिजे. वी शुड बी अवेअर ऑफ व्हॉट वी आर ट्राईंग टू डू. इन्व्हेस्टमेंट इज अ सिरियस बिझनेस. Don't make it a forwarding business. So when you are looking at a woodcutter, the compounding and patience are your gold and silver axes, and the core portfolio is your iron axe. So always focus on the iron axe. The gold and silver will always follow in terms of compounding and patience. याचं एक्सटेंडेड वर्जन असं आहे की त्या ॲक्सच्या ऐवजी या माणसाची बायको पडते त्या पॉन्ड मध्ये, आणि पहिली जी बाई काढते ती एंजल बाहेर, ती एकदम सुंदर नटी असते. तर तो माणूस नाही म्हणतो. दुसरी सुपर मॉडेल असते, नाही म्हणतो. आणि तिसरी त्याची बायको, तो म्हणतो की नाही, मला माझी बायको पण नको. म्हणले अरे असं काय, तुला पहिली मी एवढी सुंदर नटी दिली, तू का नाही घेतली? तो म्हटला की मला एकतर परवडत नाही, माझी बायको आहे ती, सुंदर नटी घेतली तर अजून परवडणार नाही. देर इज अ कॉस्ट फॉर समथिंग विच इज अ ट्रेंड, अँड दॅट कॉस्ट यू शुड बी अवेअर ऑफ. सो टेक दॅट रिस्क इन टू अकाउंट वेन यू आर इन्व्हेस्टिंग युअर हार्ड अर्न मनी. सिंपल आहे. चाणक्याच्या वेळेला झालेली गोष्ट आहे की आपल्याला जेव्हा आई वरण भात कालवून द्यायची, किंवा अजूनही मला देते कधी कधी, जेव्हा आमटी भात आपण खातो तेव्हा कधीही आपण मधनं भात खात नाही. आपल्याला कायम आई सांगते कडेनी सुरुवात कर, कडेनी सुरुवात कर, कारण ती जास्त गरम नसते, आणि मग ते करत करत आपण मध्ये येऊन खातो. दिस इज एक्झॅक्टली व्हॉट हॅपन्ड विथ चाणक्य. जेव्हा हिज मॉम टोल्ड हिम दॅट चक्रव्यूह जर, आणि त्या अर्जुनाचा चक्रव्यूह नाही, महाभारतातलं नव्हे, एक किंगडम जेव्हा घ्यायचं होतं तेव्हा बाहेरनं सगळं पहिल्यांदी कॅप्चर करत जा, आणि ते कॅप्चर केलंस तर आत गेलास तर तुला तुझं जे काय पाहिजे ते मिळेल. ॲट टाइम्स we generally don't take our life partners, our moms seriously in terms of advice. At times, a simple advice actually can also win kingdoms. प्रॉब्लेम काय आहे की लोकांना आता कोणाच्या तरी पुढे जायचंय, बरोबर. हा सगळा अट्टास कशासाठी आहे? कोणाच्या तरी पुढे जाण्यासाठी. पुढे जाण्यासाठी अट्टाहास नाहीये, कोणाच्या तरी पुढे जाण्यासाठी अट्टाहास. आणि जेव्हा कोणाच्या तरी पुढे जाण्याचा अट्टाहास असतो तेव्हा चूक होते. जेव्हा पुढे जायचं असतं तेव्हा पोर्टफोलिओ बरोबर आपण रिस्क बघून इन्व्हेस्ट करतो. दिस इज अ क्लासिक वन. अँड this we have heard from none other than चार्ली मंगर. आणि चार्ली मंगर एकदा एका दुकानात गेले होते आणि तेव्हा त्यांना फिशुक्स तिथे दिसले काउंटरवरती. अँड देन ही आस्क्ड द सेल्समन दॅट डू पीपल रिअली बाय दीज, म्हणजे ह्यानी मासा गळायला लागतो का ॲक्च्युली, वाय आर यू सेलिंग. तर त्या सेल्समननी उत्तर दिलं होतं चार्ली मंगरला दॅट आय डू नॉट सेल दिस फिशुक्स टू फिश, राईट. What that meant, and Charlie has mentioned it in his memoir also, what that meant is clearly what is sold to you, it will appear shiny. And it appears shiny because they want you to buy. What you want to buy is seldom shiny. So any new product, any new, बरेच वेळेला मला इन्व्हेस्टमेंट कम इन्शुरन्स प्रोडक्ट असतात त्याचे फॉरवर्ड येतात की हे घ्यायला पाहिजे का. डोळे उघडे ठेवून इन्व्हेस्ट करा. दॅट इज माय ओनली आस्क ऑफ यू. द ब्युटिफुल फिश हुक्स आर फॉर द बायर, दे आर नॉट फॉर द फिशेस. हुक पॉलिश केलेला नसेल, कलर लावलेला नसेल तरी सुद्धा मासा गळाला लागतोच. दिस इज फॉर द बायर टू क्रिएट अन अटेन्शन टू हॅव मोर सेल्स. शंकराची स्टोरी आहे, शेवटच्या 2 स्टोरीज आहेत. एकदा शंकर खूप चिडले and he said that for the next 12 years there will be no rain in this region. All the farmers in that region got really worried and they went to Vishnu and they said that there will be no rain for 12 years. What will we produce? What will we be eating? How will we survive? Vishnu said that there will be rain once Shiva plays his damru. And in the background, Vishnu goes and tells Shiva that don't play the damru for the next 12 years. Okay? So everybody is tensed. People in the village, they are relaxed. Karan kamach nahi, shetis nahi. Everybody says, I don't want to do anything because there is no rain. So there will be no income. So there will be nothing to do. But there was one farmer who kept on plowing, who kept on sowing, who kept on reaping, but there was no crop. It happened for a couple of years. In the 3rd year, people asked him, "Yaar, tu veda hai iska? There is going to be no rain. Why are you trying to do this?" And to manto, in 12 years, I might forget farming if I don't practice it on a yearly basis. Hey Aikun, Parvati listens to this. And she goes to Shiva and she says, I think it is time for you to play the damru, because if you don't play the damru in 12 years, you will forget how to play the damru. So it is patience. You have to actually keep on doing what you are doing. मार्केट खाली गेलं म्हणून जास्त पैसे टाकायची गरज नाही, ती SIP कंटिन्यू करा. लोकांनी प्रश्न विचारला, मी पैसे टाकू का? जनरली अनुभव असा असतो की when markets go down, you stop the SIP. And when market is going up, you increase the SIP. It has to be exactly reverse. So do not forget to play the damru, irrespective of whatever comes. This is a World War II case study. And in this case study, what had happened is that this is actual diagram of a fighter plane which came back in the Allied forces camp. This is the plane which survived. And everybody, there was a think group, and everybody was actually thinking, okay, if you see the bullet holes, that clearly means that we need to put more armor around this so that the aeroplane will not get hit. But problem asa hota ki the more armor you put, the more sluggish the aeroplane will become. The drag will be high, you will not be able to fly high, neither fly faster. So how will you solve this problem? Everybody was actually thinking that how will you solve this problem, because you need to put armor at quite a number of places. There was a Greek statistician who was invited to this group as an observer. His name was Mr. Wald. And that Greek statistician, he actually thought for some time and he said this entire data is wrong. And people there, they were defense experts. They said, why are you saying so? Why is this data wrong? And he said that you are looking at aeroplanes which actually survived the attack and came back. But what about the aeroplanes which got hit and which never came back? Do you exactly know where they got hit? You need to find out where those aeroplanes got hit, and the armor has to be put there rather than here, because on the fuselage and on the wing, when you get hit, the aeroplane might still come back. So the data at times might suggest you anything. The data has been suggesting to you, saying that your GDP is growing at 6% and your inflation is at 3%. So your return cannot be more than 9%. So if any fund manager or advisor tells you that you will compound at 15%, he is bluffing. But you have selective hearing, you don't want to listen to 9%, because 9% the cooperative bank पण देते, मग equity मध्ये कशाला जायला पाहिजे. So the missing bullet hole is actually you have to look at data which is not in front of you, and that is very, very critical. So always look at data which is not presented, but the data which is not presented to you. Till about 1960s, cigarettes were delivered on hospital beds and whiskeys were served in vending machines in the hospital waiting areas. The logic is simple. Even if you are dying, लोकांचं म्हणणं असतं की एकदा तरी शेवटचं काहीतरी करून जातो. That is exactly what happens when you try to average in a small cap stock which has gone down 70%. Don't do a revenge trade where you want to earn from the same stock because you have lost money in a particular stock. Don't try to do that. That is going to give you more pain. So quickly wrapping up, can we have the morals of these? For the turkey, don't extrapolate to infinity in a dynamic world. That's the message what should come out of the turkey. Do not extrapolate your returns. For the cap seller, markets are SIAs, which is complex, emergent, adaptive systems. मार्केटलाही आजोबा असतात. मार्केट पटकन आपल्यापेक्षा जास्त लवकर मार्केटला कळतं. सो मागच्या वेळेला झालं म्हणून ह्या वेळेला होईल. The most craziest comment I have heard from a mutual fund relationship manager is that because last 18 months did not give returns, now the market will deliver returns. Correct? Markets are not like that. They will not follow what you want them to happen. The third one was the Buddha. First, do no harm to your portfolio. A. B. Avoid grave mistakes, which is damage beyond repair. रिअल इस्टेट वाल्या बिल्डरला आपण 21% फंड नाही करत, कारण रिस्क वाटते. पण बाणेरमध्ये 20,000 रुपये स्क्वेअर फीटनी फ्लॅट बुक करायचा, तो रिअल इस्टेट वाला ज्यांनी 21% फंडिंग घेतलंय त्याच्याच स्कीममध्ये. डेरिव्हेटिव्ह प्ले काय असतो थोडा विचार करा, की आपण रिस्क तीच घेतोय when we are trying to do this. Monkey and the goat, good investments will offer positive compounding, and conversely, of course. Be it your house or portfolio, don't turn it into a zoo. Buy what is relevant to reach your portfolio goals. सगळं हवंय आदर्शासारखं करू नका. This one is brilliant. Do not write off the power of simple yet intrinsically powerful ideas implemented by the humble. Most often, we ignore this advice given by the most humble character in the family. The fish hook theory, good investing is boring, Buy not what is shiny, but what can possibly shine. Stick to your asset allocation there. Markets will test you across cycles. Don't lose guard on your discipline, persistence, and tenacity. Try to look at the market objectively without any biases or prejudices. Look at the data which is not presented. The last one is never say never and never say ever. Between falsehood and useless truth, there is little difference. As gold which he cannot spend will make no man rich, so knowledge which he cannot apply will make no man wise. Thank you very much for patiently listening to me. Thank you. आणि मी प्रेझेंटेशन असं देतो so that there will be no questions afterwards. So thank you for that.
Thank you, sir. For our next session, we turn to the space that has been generating considerable interest in the investment world, Specialized Investment Funds, SIFs. To explore this theme, we have an engaging conversation lined up. Here with us is Mr. Bhavesh Jain, co-head of Factor Investing at Edelweiss AMC. With over 16 years of experience in financial markets and a long association with Edelweiss, he has worked across trading, arbitrage strategies, and factor-based investing, and currently manages several flagship strategies under Edelweiss. And who better to engage him in this conversation than someone who truly understands what matters to investors, Mr. Deepak Jain, President and Head of Sales at Edelweiss AMC. He's a seasoned business leader with around 2 decades of success in driving sales and business expansion across financial services industry. So ladies and gentlemen, let us welcome Mr. Deepak Jain and Mr. Bhavesh Jain.
Good evening, everyone. So after 3 sessions of simplifying and yet powerful narrative, we are here to complicate your lives by talking about stuff which may sound very complicated, but we are trying to make a simple use case for investors. Yes, we are talking about specialized investment fund. So Bhavesh, let me straight away get into the subject. Today, we have plethora of investment opportunities available, especially on the publicly managed platforms, whether it is mutual funds, PMS services, alternate investments. Why exactly the need for AIF, and how does SIF really fit into this picture?
Deepak, I think today you have multiple investment vehicles, particularly on public platform. You can invest in mutual fund, AIF, and PMS broadly. And now the fourth one is SIF. So I think all the 3 alternatives have done a great job. So mutual fund in last 30 years have done a wonderful job. We are more than 80 lakh thousand crores of AUM. But each of these vehicle, whether it is PMS, AIF, or mutual fund, have some advantage, but at the same time they have some disadvantages also. So in mutual fund, you have the beauty of SIP. You can start with smaller ticket size. You get great taxation advantage, but flexibility to the fund manager is very limited. By design, all your mutual funds are long only funds. So even if, like in today's scenario where I am, say, I'm slightly worried about market, I'm worried about geopolitical situation. In mutual fund, at best, I can take only cash call. I cannot make profit by going short on market, or by taking some, expressing my negative view on markets or particular stock or a particular sector. So that is the flexibility angle which is missing. Coming to PMS and AIF, I think again, great product, but taxation is something which is not that efficient. In a PMS, as a fund manager, if I do 1000 trade, I have to pay tax on each of the transaction. Similarly, on the AIF, even if as a fund manager, I don't pay any tax, but as an investor, even if you don't redeem, the fund has to pay the tax as soon as the financial year end. So again, challenge of taxation. Second challenge on PMS and AIF is minimum ticket size. You have to start with 50 lakh for a PMS and almost 1 crore for an AIF. So the problem of mutual fund is lack of flexibility. The problem of AIF and PMS is larger ticket size and taxation. So SIF is something which is somewhere in between. You get flexibility of an AIF because now you are allowed to trade derivatives, you are allowed to go short on market, you are allowed to do a lot of other things which mutual fund cannot do in normal course. At the same time, entire taxation of mutual fund is applicable to SIF also.
So let me summarize this. Where mutual fund really scores is efficiency from a taxation point of view, easy onboarding and ticket size. Whereas PMS and AIFs, though very flexible from an investment point of view, they are tax inefficient vehicles and not necessarily easy and convenient for everyone to onboard because of onboarding requirements as well as minimum ticket size. For example, in AIF, the minimum ticket size is a 1 crore and you may not necessarily be able to diversify across multiple managers. Is that correct?
Yes.
So how does SIF really fit into this?
Yep. So I think in simple word, what we say SIF is nothing but mini AIF with mutual fund taxation. The reason we say mini AIF because still there are few, you can say, things which are missing in SIF, like mutual funds cannot take leverage. In AIF, you can take 100% leverage. So if your AUM is 1 crore, you can take 2 crore exposure. In SIF, it is mutual fund like similar things. You cannot take any leverage. Second, in AIF, there is no restriction on shorting. You can short 100% of your portfolio. In SIF, again, there is a restriction. You can only short 25% of your AUM. Maximum short limit is 25%. But at the same time, whatever disadvantage an SIF have over an AIF, more than that is compensated because of mutual fund taxation. So I think in simple word, for everyone to understand, this is mini AIF with mutual fund taxation.
So from a taxation perspective, let me just clarify. PMS may, the taxation is at the investor level for every transaction because the demat account is opened in your name. Any transaction that you do, it is taxed or subject to tax at your level. In AIF, it is at the fund level. Every year, either you have to pay the tax or provide the tax. Mutual fund is the only vehicle where the scheme is never required to pay any tax. Please bear in mind, because of section 1023D, the scheme never pays tax. The investor pays tax only when the redemption is made, correct?
Yes.
So you spoke about a few things that are not possible in mutual funds, but are possible in SIF. Before that, who are eligible to launch SIFs? Who can launch an SIF?
So I think SIF, existing mutual fund can definitely launch SIF. They have to meet just a certain criteria on minimum AUM they have managed. And any new participant, like a lot of wealth house we are seeing, or a lot of AIF, they are also in the process to launch SIF, but they need to hire a CIO with minimum amount of experience and minimum AUM managed historically. So that is the two requirement. So that is an alternate route, and there is a straight route for existing mutual fund. Both of them can launch SIF.
So you need to have a mutual fund license to launch an SIF scheme, whether the current brand of mutual fund or new ones who can apply for mutual fund license to launch an SIF vehicle, because SIF is nothing but a 10 lakh ka mutual fund in that sense, correct? So let's now delve into some of the strategies or things that are restrictive in mutual fund and can be done in an SIF. So let's talk about one of those and then we can move forward. So what is one or two example that you can give, Bhavesh, which are not possible in mutual fund, by giving a trading example, and which is possible in SIF and can help generate returns?
Sure. I think, as I said, the first and the most important thing is to express your view even when you are negative on market. So in SIF, you can actually take short position. Today, when you see that crude oil price is already above $90, you feel that some of the sectors definitely will have much larger pain compared to few others. So you can actually play a long short trade now. You can go long on the particular sectors which will benefit because of higher crude oil price, and you can go short on some sectors which will have disadvantage because of this higher crude oil price. Second, and something which is, I think most of people will be aware that in mutual fund also you can do covered call. Now covered call is a strategy where you buy equity, you think that my upside is limited, but if markets remain sideways, if markets remain range bound, how do I make more profit in a range bound market? So you can do that by selling call option. You sell call option, if stock price doesn't move up, you pocket the premium, and if the stock price go up, anyways you make profit on your underlying equity. Here in mutual fund, the restriction is I can do covered call only in Nifty 50 names. So that means if I am having a stocks which is not part of Nifty 50 names and still the stock is part of my portfolio, I cannot do covered call in those stocks. But now in SIF, you can do covered call in all FNO names. Second restriction was in mutual fund, even if the stock is part of Nifty 50, you can do covered call only on 30% of your holding. So for example, if I have 1 lakh Reliance in my balance advantage fund or my large cap fund, I can sell call option only on 30,000 equity shares, and remaining 70,000 compulsory I have to keep long. In SIF, if I have 1 lakh Reliance, I can do entire 1 lakh covered call. If I have non-Nifty names, for example, if I have MCX, if I have BSE, which are not part of Nifty 50, in my existing fund, I cannot write call option. In SIF, you can write call options over there also. So that is the advantage you get, because normally you will see the premium what you get is much higher in a mid cap and a small cap name compared to a large cap name, and that is where you generate extra return.
थोड़ा धीरे करते हैं इसको भावेश. मैं एक ट्रेडिशनल इन्वेस्टर हूँ. मैंने बैलेंस एडवांटेज फंड में इन्वेस्ट किया है, मैंने आर्बिट्राज फंड में इन्वेस्ट किया है. देन आई अंडरस्टैंड कि समटाइम्स टू हेज योर पोजीशन, आपने जो स्टॉक लिया हुआ है उसका आप फ्यूचर बेच देते हो, एंड यू क्रिएट एन आर्बिट्राज पोजीशन आइदर थ्रू एन आर्बिट्राज फंड और इन अ बैलेंस एडवांटेज फंड. ये कवर्ड कॉल, इफ यू कैन एक्सप्लेन द डिफरेंस बिटवीन अ कवर्ड कॉल and an arbitrage trade, and how do you exactly benefit from it?
Sure. So आप जब आर्बिट्राज करते हो, आप कंप्लीटली अपनी पोजीशन को हेज कर लेते हो. मैंने 1 लाख रिलायंस लिया, सामने 1 लाख रिलायंस का फ्यूचर बेचा, माय पोजीशन इज नाउ कंप्लीटली हेज. रिलायंस ऊपर भी चला जाए, रिलायंस नीचे भी चला जाए, आई विल नाइदर हैव एनी एडवांटेज नाइदर एनी डिसएडवांटेज. माय प्रॉफिट इज लॉक्ड. कैश और फ्यूचर के बीच में जो गैप है, आपने 1500 में रिलायंस लिया और 1510 में उसका फ्यूचर बेचा, आपका प्रॉफिट 10 रुपए ही रहेगा, चाहे रिलायंस 1000 रुपया हो जाए या रिलायंस 5000 रुपया हो जाए. इन कवर्ड कॉल द मैथ्स इज स्लाइटली डिफरेंट. यू कैन डू कवर्ड कॉल बाय सेलिंग इन द मनी कॉल ऑप्शन, एट द मनी कॉल ऑप्शन एंड आउट ऑफ द मनी कॉल ऑप्शन. बट जस्ट टू कीप इट सिंपल, मैंने 1500 में रिलायंस लिया, मुझे लग रहा है कि रिलायंस शायद 100 रुपया ऊपर जा सकता है, नीचे भी जा सकता है, पर मुझे रिलायंस तो लॉन्ग रखना ही है. तो उस सिचुएशन में आप क्या करोगे? 1500 में रिलायंस लिया है, 1600 का 1700 का कॉल आपने 15-20 रुपए में बेच दिया. अब अगर रिलायंस पूरे महीने में 1600-1700 जाता है, आपको वो 1500 से 1700 के रिटर्न्स तो मिलेंगे ही, प्लस जो आपने ऑप्शंस बेच के 15 रुपए 20 रुपए कमाए थे वो भी आपको मिलेंगे. लेकिन अगर किसी भी रीजन से रिलायंस 1500 का 1500 रहता है या 1500 से नीचे भी जाता है, यू स्टिल मेक दैट 15-20 रुपीज प्रॉफिट विच इज रफली 1% पर मंथ, और आपका कॉस्ट ऑफ होल्डिंग कम होते जाएगा. लास्ट 4 महीने से मार्केट नेगेटिव है. अगर आपने 4 महीने में रिलायंस का कॉल बेचा रहता, आपने हर महीने 1-1% कमाया रहता, यू वुड हैव मेड 4% प्रॉफिट विदाउट रिलायंस गोइंग एनीवेयर. रिलायंस जहां पे था वही का वही पे है, लेकिन आपने 4% का प्रॉफिट बनाया. ये हो गई रिटर्न्स की बात. लेकिन रिस्क, अगर रिलायंस 1500 का 2000 हो गया, तो आर्बिट्राज में भी आपकी कमाई 10 रुपए थी, कवर्ड कॉल में एटलीस्ट आपकी कमाई 20 रुपए 30 रुपए 50 रुपए रहेगी, रादर देन आर्बिट्राज में जहां पे आपकी कमाई 10 रुपए पे लॉक हो गई थी. सो दैट इज हाउ यू प्ले, because covered call में on the upside you get slightly better return, on the downside you get better protection. आर्बिट्राज में आपका अपसाइड और डाउनसाइड दोनों ही कैप हो जाता है. नाइदर यू मेक प्रॉफिट नाइदर यू लूज मनी. कवर्ड कॉल में अपसाइड में आप थोड़ा कैप्चर कर सकते हो, डाउनसाइड में आपका प्रोटेक्शन, जितना आपने प्रीमियम कलेक्ट किया उतना आपको प्रोटेक्शन भी मिल जाता है.
जैसे आर्बिट्राज में मानी हुई बात है, आपको 6-7% रिटर्न मिल जाता है, कभी ज़्यादा भी मिल जाता है, कभी कम भी. ये कवर्ड कॉल स्ट्रैटेजी में अगर आप 20-25-30% करें तो ये कितना रिटर्न जनरेट कर सकता है?
तो
और
कवर्ड कॉल,
इसका रिस्क क्या है, डाउनसाइड क्या है?
यस, सो अगर आप देखोगे कवर्ड कॉल जो हम लोग हमारे SIF में कर रहे हैं, वी आर डूइंग स्लाइटली डिफरेंट थिंग. हम लोग इन द मनी कॉल ऑप्शन बेचते हैं, यानी कि मेरा यहाँ पे टारगेट है आर्बिट्राज से 2%, 3%, 4% के एक्स्ट्रा रिटर्न जनरेट करना. आर्बिट्राज में नॉर्मली आपके रिटर्न होते हैं 6%, 7%, 7.5%। मेरा टारगेट है 10% के आसपास के रिटर्न जनरेट करना। तो हम लोग क्या करते हैं, 1500 में रिलायंस लिया, मैंने 1400 का कॉल ऑप्शन बेचा है, यानी कि डीप इन द मनी का कॉल ऑप्शन बेचा है। 1500 में लिया है, 1400 का कॉल बेचा है 120-130 रुपए में। सो सेम मैथ्स, आर्बिट्राज में आपका प्रॉफिट 1500 और 1510 का गैप 10 रुपए था, यहाँ पे आपका प्रॉफिट 30 रुपए है। आपने 1400 का कॉल बेचा है 130 रुपए में, सो यू मेक 130। सो इफेक्टिवली आपका फ्यूचर शॉर्ट का जो प्राइस है वो 1530 रुपए हो गया। तो आपने 1500 में रिलायंस लिया है, 1530 में फ्यूचर बेचा है, आप 30 रुपया कमा रहे हो, जबकि नॉर्मल कैश फ्यूचर आर्बिट्राज में आपकी कमाई खाली 10 रुपए थी। नाउ 30 रुपीज पर मंथ, यानी कि 2% हो गया, साल का 24% हो जाता है। तो दिखने में और सुनने में बहुत अच्छा लगेगा, लेकिन रिस्क क्या है, जिस महीने में रिलायंस जितना आपने प्रीमियम कलेक्ट किया है, जैसे इस केस में मैंने 130 रुपए प्रीमियम कलेक्ट किया था, जिस महीने में रिलायंस 130 रुपए से ज्यादा गिरेगा आपको लॉस होगा। तो यू आर टेकिंग सम अमाउंट ऑफ रिस्क, लेकिन अगर ये रिस्क आपने ठीक से मैनेज कर लिया तो 15%, 14%, 12% के रिटर्न आपको इजीली मिल सकते हैं, विच इज ऑलमोस्ट डबल ऑफ आर्बिट्राज।
तो 100 रुपए हर महीने लूज करना पड़ेगा। अगर मैं 50-50 रुपए 6 महीने लूज किया
तो आपके लिए कोई प्रॉब्लम नहीं है, क्योंकि आपने जब जब एक्सपायरी होती है आप 100 रुपए नीचे का कॉल ऑप्शन बेचते हो, तो एक महीने में अगर रिलायंस 50 रुपए गिर रहा है और वो 6 महीने 8 महीने लगातार भी गिर जाए, आपको प्रॉब्लम नहीं है। एक्सपायरी टू एक्सपायरी अगर रिलायंस 100 रुपए या 130 रुपए से ज्यादा गिरा तो ही आपका लॉस है। अगर रिलायंस 50 रुपए गिरा, 70 रुपए गिरा, 60 रुपए गिरा, आपको कोई लॉस नहीं है, आपको उस महीने में 30 रुपए का प्रॉफिट पूरा मिलेगा।
तो कहने का मतलब है अगर आप ढंग से करें तो इस स्ट्रेटेजी में पैसे बनाए जा सकते हैं।
यस।
और क्या कर सकते हैं हम SIF में जो जनरली म्यूचुअल फंड्स में नहीं करते, जो कि पॉसिबल भी है लेकिन करते नहीं है लोग?
यस, तो आई थिंक एक और चीज होती है, अगर आप देखोगे नॉर्मली बहुत सारे ब्लॉक्स मार्केट में होते हैं, बहुत सारे QIP के ट्रेड मार्केट्स में होते हैं, बहुत सारे OFS मार्केट में होते हैं। तो म्यूचुअल फंड बाय डिजाइन सिर्फ लॉन्ग कर सकता है। तो कल जब प्रमोटर ब्लॉक में माल बेचेगा तो म्यूचुअल फंड
ये ब्लॉक थोड़ा समझाएं, थोड़ा सा सिंपली।
तो ब्लॉक है जहाँ पे कोई बड़ा लार्ज शेयर होल्डर है जो बोलेगा कि मुझे 5% ऑफ द कंपनी बेचना है, 3% ऑफ द कंपनी बेचना है, एंड आई एम रेडी टू गिव यू 5% डिस्काउंट, 10% डिस्काउंट। तो ये ट्रेड नॉर्मली या तो ब्लॉक विंडो में होते हैं, जो कि मार्केट खुलने से पहले होते हैं, या बहुत बार ड्यूरिंग द मार्केट भी हो जाते हैं। अब एज अ म्यूचुअल फंड आप क्या कर सकते हो, जब ब्लॉक होगा, 1000 रुपए का स्टॉक है, 950 पे ट्रेड होगा, म्यूचुअल फंड 950 पे खरीद लेगा। लेकिन उसके बाद में उनका प्रॉफिट कब होगा, जब ये 950 का शेयर वापस 1000 रुपए आएगा तो उनका प्रॉफिट होगा। म्यूचुअल फंड के सामने SIF को एडवांटेज क्या है, मैंने आज ही फ्यूचर 1000 रुपए में बेच दिया, कल 950 में ब्लॉक में खरीद लिया, मेरा 50 रुपए का प्रॉफिट लॉक हो गया। ये म्यूचुअल फंड नहीं कर सकता, SIF कर सकता है। तो ऐसे ट्रेड्स का आपको बहुत बड़ा फायदा मिलेगा।
तो आप कौन सा प्रोडक्ट अभी लॉन्च किए हो और उसका क्या परफॉर्मेंस रहा है और क्या एक्सपेक्ट करना चाहिए इन्वेस्टर्स को?
यस, तो आई थिंक जो पहला प्रोडक्ट हमने लॉन्च किया है SIF में, दैट इज हाइब्रिड लॉन्ग शॉर्ट फंड। जैसे इक्विटी में, म्यूचुअल फंड में होता है, कुछ इक्विटी फंड है, कुछ डेट फंड है और कुछ हाइब्रिड फंड है। सेम चीज SIF में भी है, इक्विटी SIF भी है, डेट SIF भी है और हाइब्रिड SIF भी है। हमने जो फंड लॉन्च किया वो हाइब्रिड SIF का पार्ट है। हमारी जो स्ट्रैटेजी है जिसका नाम है ऑल्टिवा हाइब्रिड लॉन्ग शॉर्ट फंड, जैसे मैंने कहा, इसका यूज केस ये है कि हम आपको आर्बिट्राज से 3%, 2%, 4% के ज्यादा रिटर्न जनरेट करके देना चाहते हैं विदाउट टेकिंग मीनिंगफुल रिस्क। तो मेरे पोर्टफोलियो में आप देखोगे हम लोग 50% इक्विटी और 50% डेट लेके चलते हैं। आपका पोर्टफोलियो में जो डेट इक्विटी होता है वो टैक्टिकल होता है, वो जैसे हमने आर्बिट्राज कहा, कवर्ड कॉल के ट्रेड कहा, IPO, ओपन ऑफर, बायबैक, ब्लॉक्स, ये सारे ट्रेड है। इस तरीके के टैक्टिकल ट्रेड हम लेते हैं। हम कोई लॉन्ग इक्विटी या शॉर्ट इक्विटी नहीं चलाते। जो भी इक्विटी एक्सपोजर है वो प्योरली टैक्टिकल इन नेचर, शॉर्ट टर्म इन नेचर होता है। हमने जो लास्ट 4-4.5 महीने हमको चालू हो गए, ये फंड चालू करके हो चुके हैं, इस 4.5 महीने के पीरियड में निफ्टी के रिटर्न है नेगेटिव 5.5%, हमारे स्ट्रैटेजी के रिटर्न है पॉजिटिव 3.5%। तो हमने ये 3.5% के रिटर्न जो जनरेट किए हैं, हमारे पोर्टफोलियो की वोलाटिलिटी इस पीरियड में अगर आप देखोगे, निफ्टी की वोलाटिलिटी या स्टैंडर्ड डिविएशन जो हम कहते हैं वो ऑलमोस्ट 10% के आसपास है। हमारे पोर्टफोलियो का स्टैंडर्ड डिविएशन या वोलाटिलिटी 2% के आसपास है। तो निफ्टी से 20% रिस्क हमने लिया है और निफ्टी नेगेटिव 5.5 है, हम पॉजिटिव 3.5 है। तो इस तरीके के रिटर्न जहाँ पे मार्केट से आपका कोई लेना देना नहीं है, मार्केट अग्नोस्टिक आप रिटर्न दे रहे हो, मोर लाइक एन हेज फंड स्ट्रैटेजी, एब्सोल्यूट रिटर्न फंड स्ट्रैटेजी, जहाँ पे मार्केट किसी भी डायरेक्शन में जाए, आपका इंटेंशन ये है कि साल भर में 8 से 10% के रिटर्न बनने चाहिए।
तो इसको आर्बिट्राज प्लस कहना उचित होगा कि गलत होगा?
यस, तो दिस इज द स्ट्रैटेजी जो आपके आर्बिट्राज फंड और इक्विटी सेविंग फंड के बीच में आती है। 100% हेज नहीं है आर्बिट्राज की तरह, एट द सेम टाइम इसमें कोई कोर इक्विटी पोर्टफोलियो 20%, 40%, 50%, जैसा आपके इक्विटी सेविंग फंड में या बैलेंस एडवांटेज फंड में होता है, उस तरीके का कोई भी कोर इक्विटी पोर्टफोलियो यहाँ पे नहीं है.
सो बिना डायरेक्शनल इक्विटी के भी 9-10% रिटर्न जनरेट किया जा सकता है.
Yes.
तो ये जो 9-10% की जो आप बात कर रहे हैं, अगर 100 रुपया आपको मिलता है, आप कैसे उसको निवेश करते हो और इन्वेस्टर्स को कितने होराइजन में ये 9-10% दिख जाएगा?
तो आप देखोगे फॉर एवरी 100 रुपीज व्हाट वी गेट, हम लोग ऑलमोस्ट 50 रुपया डेट में लगाते हैं, 50 रुपया इक्विटी में लगाते हैं. डेट में वी डोंट गो बियॉन्ड AA रेटेड पेपर, तो AA, AAA, टी बिल्स ये हम लेते हैं. और इक्विटी में जैसा मैंने कहा 50% जो हम लगाते हैं, ऑलमोस्ट 35% कैश फ्यूचर आर्बिट्राज और कवर्ड कॉल आर्बिट्राज में होता है, और बाकी का 15% जो भी सेबी ने डेरिवेटिव स्ट्रैटेजीज अलाउ की है, हम लोग उसमें इन्वेस्ट करते हैं. इसके अलावा एक साइजेबल पोर्शन जो हम लोग डेट में रखते हैं, उसका इस्तेमाल हम करते हैं जब भी मार्केट में स्पेशल सिचुएशन ट्रेड हो, कोई अच्छा आईपीओ है, कोई अच्छा ओपन ऑफर है, कोई अच्छा बायबैक है, तब हम लोग ये पैसा डेट से निकाल के उस शॉर्ट टर्म ट्रेड में यूज करते हैं. और जैसे ही वो ट्रेड खत्म होता है, फिर से ये पैसा हम लोग AAA रेटेड डेट में डाल देते हैं. ऑन एन एवरेज हमारा मानना है कि अगर आप इस फंड में 18 महीने से 24 महीने का टाइम स्पेंड करते हो, तो यू शुड इजीली एक्सपेक्ट 9 to 10% रिटर्न.
तो 9 से 10% ओवर 18 to 24 मंथ्स. दैट्स वेरी गुड. टैक्सेशन क्या है इस प्रोडक्ट का?
सो टैक्सेशन समझना होगा, ये एक हाइब्रिड फंड है. जैसा मैंने कहा, ना मेरा इक्विटी 65% से ऊपर है, ना मेरा डेट 65% से ऊपर है. यानी कि ना तो ये एक फिक्स्ड इनकम प्रोडक्ट है, ना तो ये एक इक्विटी प्रोडक्ट है. टैक्सेशन वाइज जो स्टैंडर्ड टैक्सेशन रेट होती है, जो नॉर्मली आप देखोगे आपके इनकम प्लस आर्बिट्राज में, आपके किसी मल्टी एसेट फंड में, बाकी सारे फंड्स में जो होती है, 24 महीने के बाद में 12.5% और 24 महीने से कम आपका स्लैब रेट. लेकिन हमें एक फायदा है, क्योंकि हम एक हाइब्रिड SIF की कैटेगरी में आते हैं. हमारे पास कंपलसरी लिस्टिंग करना होता है, हमारे यूनिट स्टॉक एक्सचेंज पे लिस्टेड होते हैं, तो हमें एक लिस्टेड यूनिट का जो लिस्टेड सिक्योरिटीज का जो टैक्सेशन का बेनिफिट मिलता है, वो हमें भी मिलता है. इसका मतलब 1 साल के बाद में आपको जो लॉन्ग टर्म कैपिटल गेन टैक्स है 12.5% वो लगेगा, और अप टू 1 ईयर ये आपको आपके स्लैब रेट के हिसाब से टैक्स लगेगा. इक्विटी की तरह नहीं है जहाँ पे 1 साल 20% होता है, यहाँ पे 1 साल आपके स्लैब रेट के हिसाब से है. 12 महीने के बाद, 1 साल के बाद में इक्विटी का भी 12.5% टैक्स है, यहाँ का भी 12.5% टैक्स है, लेकिन 1 साल तक दोनों के टैक्स में डिफरेंस है.
तो 1 साल के बाद आपको 12.5% टैक्स देना है और 9-10% की रिटर्न एक्सपेक्टेशन होनी चाहिए ओवर 18 to 24 months.
Yes.
Is this the short and long of Altiva hybrid long short?
Yes, that is what we want to achieve.
Thank you. Thank you so much, Bhavesh. I think we have tried to covered in brief something about SIF and the product that we have launched. Happy to take questions from anybody who would like us to answer.
Hello. Thank you, Bhavesh sir and Deepak sir. This felt like a YouTube presentation which was at 2x. It was pretty fast. I am sure it was overwhelming for all the investors as well. What I would suggest to all the investors is to connect with your relationship manager and see which part of SIF is suitable for your requirement, and we'll take it forward from there. Thank you, Bhavesh sir and Deepak sir, for making a detailed presentation on that. And I think we'll move forward with this. I would like to call upon stage Mudit Bansal sir and Ajit Deshmukh sir, please, to felicitate Bhavesh Jain sir and Deepak Jain sir. Thank you. Thank you. With this, we come to the end of this wonderful evening. Thank you all the clients for joining us today, for listening to all the insightful conversations. I would like to thank all the speakers who are sharing their ideas, thoughts, and views. This was very useful for all of us. Thank you to Axis, Franklin, and Edelweiss, AMCs. Thank you to Guwahati team, Dipshika, and Yellow Media who gave us digital support. Thank you to Neeraj Mantri who helped us with all the setup that we have done here. And food and cocktail is ready, so all of you can enjoy that now. Thank you. Sapient team, please come on stage for a group photo. Thank you. Sapient and Symphonia team. Please come quickly for the group photo. Thank you.